Imagine walking into a bank, excited to get a personal loan, only to be told your interest rate will cost you hundreds, maybe thousands, more than you expected. What if I told you there's a way to flip that story and walk out with one of the lowest rates they can offer? By the end of this video, you'll know exactly how to qualify for low-interest personal loans, and I'll share a little-known tactic most beginners never think about that could save you serious money. Number 1. Understand what a low-interest loan really means. A low-interest loan is simply a loan where the lender charges you less interest compared to the average market rate. For example, if the average personal loan interest rate is around 11% and you get one at 6%, that's considered low. This difference may sound small, but on a $10,000 loan over 5 years, you could save more than $1,500 in interest. The first step to qualifying is knowing what's considered low in the current market so you can spot a good offer when you see it. Number 2. Check and improve your credit score. Your credit score is like your financial report card, and lenders love an A student. The higher your score, the lower the risk you seem to them. A score above 740 is often considered excellent and usually qualifies for the best rates. If your score is lower, focus on paying down credit card balances, making all payments on time, and not applying for too much new credit. For example, someone with a 780 score might get a 6% rate, while someone at 640 could get 18%. That difference could mean paying triple the interest. Number 3. Show proof you can repay. Lenders want to see steady income and a manageable level of debt. If you earn $4,000 a month and already owe $3,000 in other loan payments, that's a red flag. A lower debt-to-income ratio, ideally under 36%, makes you more appealing. Think of it like this. If you loan money to a friend who already owes 10 other people, you'd be nervous. Show them you're financially stable, and they'll feel safer giving you a better rate. Number 4. Shop around before saying yes. Different lenders offer very different rates for the same borrower. One bank might offer 8% while another offers 10%. Online lenders, credit unions, and even your local bank could all have different deals. Imagine going to one grocery store and paying $3 for milk when another store down the street sells it for $2. The product is the same, but your wallet feels the difference. Get quotes from at least 3 lenders before deciding. Number 5. Consider a secured personal loan. Most personal loans are unsecured, meaning you don't put up any collateral. But if you have something valuable, like a savings account, a car title, or a certificate of deposit, you could use it to secure the loan. Because this lowers the lender's risk, they often reward you with a much lower interest rate. Just remember, if you fail to repay, they can take the collateral. Number 6. Choose a shorter loan term if possible. A 5-year loan might have a higher rate than a 3-year loan. Shorter terms mean less risk for the lender, and they often give you a break on the interest rate. Yes, the monthly payments will be higher, but you'll pay less overall. For example, a $10,000 loan for 5 years at 8% might cost about $202 a month, while the same loan for 3 years at 6% might cost $304 a month. The second option costs more per month, but saves you hundreds in total interest. Number 7. Avoid applying for too many loans at once. Every time you apply for credit, the lender makes a hard inquiry on your credit report. Too many in a short period can lower your score and make you look desperate for money. Instead, do your shopping within a short window, like 2 weeks, so multiple checks count as one inquiry. This way, you protect your score while still exploring your options. Number 8. Become a member of a credit union. Credit unions are nonprofit, and they often have lower interest rates than big banks. You'll usually need to join, which might require living in a certain area, working for a certain employer, or paying a small membership fee. Once you're in, you might find rates that are 1 to 2% lower than the average. On a large loan, that difference is huge. Number 9. Use a cosigner. If your credit is not great, if you have a trusted friend or family member with strong credit, adding them as a cosigner can make lenders more willing to offer you a low interest rate. The cosigner agrees to take responsibility if you can't pay, which lowers the lender's risk. For example, if your score is 620 but your cosigner has a 780, the lender may treat the loan as if the 780 score is applying. Number 10. Keep your current bank in the loop. If you already have a checking or savings account with a bank, they may be more willing to give you a better deal because you're a loyal customer. They can see your transaction history, which can work in your favor if it shows steady deposits and responsible account management. Number 11. Negotiate your rate. Many people don't realize interest rates are not always set in stone. If you've been offered a loan at 9%, tell the lender you've been pre-approved elsewhere for 7% and ask if they can match or beat it. Even if they drop it by 0.5%, that's money in your pocket over the life of the loan. Number 12. Time your application wisely. If you know your credit score will improve in a few months because you're paying off debt or removing a negative mark, wait until then to apply. Also, interest rates in the market change with the economy. When national rates drop, lenders often follow. A little patience could save you thousands. Number 13. Bundle with other financial products. Some lenders offer a discount if you also open a checking account, take a credit card, or use them for a mortgage. This is called relationship pricing. For example, they might knock 0.25% off your personal loan rate if you set up automatic payments from a checking account you open with them. Number 14. Look for employer or membership perks. Some companies partner with banks or credit unions to offer employees special rates on loans. Professional organizations, alumni associations, and even warehouse clubs sometimes have similar deals. Before you apply, check if you have any hidden benefits you can use. Number 15. Use pre-qualification to your advantage. Many lenders let you check your possible rates without affecting your credit score. This is called a soft inquiry. It's a great way to see what you might qualify for before you commit. You can compare offers without taking a hit to your score until you're ready to officially apply. Number 16. Maintain financial stability before applying. Big changes like switching jobs, taking on new debt, or making late payments in the months before you apply can hurt your chances of getting the best rate. Lenders like to see consistency. Imagine if someone asked you for a loan right after quitting their job. You'd probably hesitate. Number 17. Keep an emergency fund. This might sound unrelated, but lenders view borrowers with savings as less risky. Even a small emergency fund shows that you can handle unexpected expenses without missing loan payments. That little-known tactic I promised you. It's combining multiple strategies at once to look like the dream borrower. For example, improving your credit score while also lowering your debt-to-income ratio, joining a credit union, and timing your application when market rates are lower. Each of these steps adds up, and together, they can drop your interest rate dramatically. Number 18. Reduce your credit utilization ratio. This means using less of your available credit. If you have a total credit limit of $10,000, and you are using $8,000. That is 80% utilization, which lenders see as risky. Aim to keep it under 30% and ideally below 10% to show you manage credit responsibly. Number 19. Show a history of saving. Regularly depositing into a savings account can make you look financially disciplined. Lenders may see this as a sign that you have a cushion for emergencies, reducing their risk and possibly earning you a better rate. Number 20. Minimize outstanding debts before applying. If you have multiple small loans or credit card balances, paying them off can improve your debt-to-income ratio. This makes your application stronger and could help secure a lower interest rate. Number 21. Choose a lender that specializes in your profile. Some lenders target specific borrower types, such as first-time borrowers, gig workers, or those with improving credit. Finding a lender that fits your situation can mean more flexible terms and lower rates. Number 22. Use a debt consolidation approach first. If you have high-interest debts, consolidating them into one lower-interest loan can improve your credit score and show better financial control before applying for a new personal loan. Number 23. Highlight stable housing history. Lenders sometimes look at whether you have lived at the same address for a while. A stable housing record can suggest reliability, which can help in negotiating lower rates. Number 24. Present additional income streams. Side hustles, freelance work, or rental income can strengthen your application. Document these properly so the lender sees your full earning power, not just your main job salary. Number 25. Opt for automatic payments. Agreeing to have your loan payments automatically withdrawn from your account each month can earn you a small rate discount with some lenders. It also shows you are serious about on-time payments. Number 26. Avoid major new purchases before applying. Financing a car, buying expensive appliances on credit, or opening a store credit account shortly before applying for a personal loan can hurt your approval chances and increase your rate. Number 27. Strengthen your employment history. Being with the same employer for a long time shows stability. If you recently started a job, waiting until you have at least 6 months to a year of work history can help your application. Number 28. Consider peer-to-peer lending platforms. Some online platforms connect borrowers directly with individual investors. They often have different criteria than banks and may offer competitive rates if your profile fits their lending preferences. Number 29. Prepare thorough documentation. Having pay stubs, tax returns, bank statements, and proof of assets ready can speed up approval and make you look like a low-risk borrower. Lenders appreciate applicants who are organized and transparent. Number 30. Build relationships with smaller community banks. These institutions may be more flexible and willing to negotiate better rates than large national banks because they value local connections. Now that you know the steps, imagine how much you could save if you started applying them today. If you were to qualify for a rate even 2% lower, how would you use the extra money you keep instead of paying it to the bank?